While people are finding their seats, we'll go ahead and kind of do some introductions. My name is Brandon Wells. I am president and CEO of the group. And I'd like to say thank you. I'm extremely grateful to be back in person after multiple years of doing this virtually. We're amazed at having all of you in this room again, and it feels really good. I want to say thank you on behalf of all of our group partners, all of our business partners, for all of our friends, our customers, and additional business partners who are in the room with us tonight. We thank you for trusting us for your regional real estate information and being a trusted source since 1976. We hope that you find tonight's event special. We hope that you learn something and informative as well. So to kind of lay out the framework for how we're going to cover our forecast, we're going to start off with a little bit of a recap and review of 2022, see how we ended up in the marketplace as it pertains to regional real estate. We'll also talk about the top stories and trend lines for 2023 and what we kind of see on the horizon. And then we've got a great panel for you this evening. We have representatives from different cities, towns, and municipalities in the development and planning sector to talk a little bit about the vision, the opportunities, the challenges as it pertains to development in our region. So I'll go ahead and I'll get this kicked off this evening with talking a little bit about some annual data as it pertains to our regional real estate markets. I'll familiarize you with this data in the 2022 year-end review for median price. So starting with Fort Collins on the left, in the dark blue is the attached and detached median price for the end of the year. Above that is the percent year-over-year change in that price. In the light blue is the single-family detached only, as well as the year-over-year change. So as you can see for Fort Collins, the combined attached and detached ended the year at $550,000, which was up 14.8%. Single-family detached ended the year at $610,000 for the region in Fort Collins, up 14%. Loveland at $510,000, up 17.7%. The single-family, $537,000 at an increase of 19.3%. Windsor and Severance are lumped together in our statistical data, an 18% increase at $559,000 for attached and detached product, and then ending the year at $583,000, up 17.6% for single-family detached. Greeley and Evans ended the year just shy of $425,000, up 16%, and $441,000 for the detached product, up 16%, just shy of 16%. Taking a look at Timnath, Timnath ended the year at $710,000. That was up almost 24% year over year. 26.3% for detached at $741,000. Wellington ended the year under $500,000 at $490,000, up 16%. And then the single family at $495,000, up 15.1%. Berthoud, 11.5% increase year over year of attached and detached, coming in just shy of $575,000, and then $593,000 for the detached only product. Johnstown at $520,000, up 13%, and $525,000 for detached only at 13.7%. All of this data, by the way, is inside of those annual reports as well, so you can follow along and look at that data as well. Meade at $573,000, 15.2% year-over-year increase in median price. $574,000 for the detached only. Milliken at $462,524, up 12.5%. And then $470,000 for detached, up 13.2%. Going a little bit further south, our neighbors in Longmont ended the year at $580,000, up 11.5%, $623,000 for single-family detached, up 12.2%, and this usually gets a few gasps from people down Boulder. $1 million median price for attached and detached, and then $1.375 million, up 9.4% year over year for single-family detached in the city of Boulder. We lumped together Alt, Eaton, Kersey, and LaSalle. Ended the year at $421,845, up 14.5%. And then $437,000 for the single-family detached. And then Estes Park ended the year up 4% for combined attached and detached at $650,000. and then the detached only product at $835,000 in Estes Park. Another addition here, and I'll talk a little bit about this in a second, is Steamboat Springs. Ended the attached and detached year at $947,500, and then single-family residents up in Steamboat, $1.675 million, pretty much flat year over year with 2021. Now, why did I mention Steamboat Springs? We had some exciting news this past year. Obviously, many of you in this room recreate, you vacation, you spend time up in Routt County and in the Yampa Valley. And in August, we strategically acquired the largest brokerage in Steamboat Springs, and now obviously have a footprint up there with 70 realtors, some amazing professionals, and really we saw it as a strategic opportunity to continue to expand into the markets that many of you enjoy to recreate, live in, and a lot of you own second homes there as well. And so we're very grateful for that opportunity up in Steamboat Springs. So how did we do on our forecasting last year? A lot of times people want to know, how did we project what would happen in the marketplace? Obviously, this year is really the tale of two stories, of really the front half of the year, or the first two quarters, and the back half of the year as it pertains to real estate. A lot of things like inflation and interest rates took center stage, which we'll talk more about tonight. But taking a look, our predictions of where we would end the year for total number of home sales, we really thought it would be about flat with last year, 13,500. Sometimes you get these predictions right, sometimes you get these predictions wrong. And I'll say we weren't as accurate as we'd love to be, because we were shocked and surprised as well at how quickly the fight against inflation impacted the marketplace really across the country. Where we ended up was 9,966 home sales, and this is for Northern Colorado, excluding Longmont, Boulder, and Estes Park. So of all those areas I mentioned, minus those, so we had about a 70% accuracy. The grade would be a C, so not very good, but really for many people, what was unforeseen, the pivot and how quickly that pivot came on and affected the overall national economy, specifically around housing. Our 2023 forecast of where do we think things will go. There's persistent supply challenges in our marketplace, coupled with some affordability challenges predominantly put on by interest rates and the Federal Reserve's fight against inflation. So we see about a 10% decrease year over year in annual home sales. So what does this mean for prices? Let's take a look at how we did on our projections for median price. We predicted that the end of the year would be below $500,000, or the $500,000 mark, at $490,000. We saw double-digit appreciation, or really double-digit year-over-year increase in median sales price in every one of those areas I went through. So we ended the year at about $513,000, which was about 95% accurate. So we did pretty good. The appreciation was higher than we had expected year over year, but really the story was the diminishing number of home sales, and we'll talk a little more about that. What do we see happening with prices? I think there's probably a lot of curiosity amongst people in the room. You've read headlines of doom and gloom coming to housing. You've read a lot of different economists kind of try to make their predictions. Is the U.S. economy headed into a recession in 2023? And ultimately, how is housing impacted? Well, we see there being a lot of demand support, and as I said before, persistent supply challenges in the marketplace. So realistically, what we see is a flat market. Something that we haven't been accustomed to in recent years, as we really just went through one of the longest and largest expansionary economies in history. We had 124 straight months in the United States of increasing home prices, and as we tailed out of the year, we saw 4 months of consistent pressure on home prices. So we really see overall flat. Now, it doesn't mean we see price decreases. We certainly see 2023 looking as though it's the inverse of 2022. A really kind of slower start to the year through the first and second quarter, but predominantly picking up a little bit of steam in the back half of the year, and I'll talk a little bit more here in a second on why. Let's take a look at appreciation. So appreciation is different than just the year-over-year median price increase. And the proper way to measure appreciation is done by the Federal Housing Finance Agency, and they take the same home sold over a long period of time. So every time it's sold or refinanced, that data gets recorded. And essentially, they take a large data set for different MSAs, and they compare that over time. So for the Fort Collins and Loveland MSA, the data goes back to 1978, and this is through the third quarter of 2022. Couple of key points. 2021 ended the year at the second highest appreciation ever on record for Fort Collins and Loveland, coming in at 18.2%. Where we are through 3 quarters of 2022 is at 13.7%, or really the 5th highest appreciation rate on record for this MSA. That brings the statistical average over that period of time to 5.7% appreciation. So really what we're projecting based on what I showed you for prices is really flat or well below average for the entire region over that period of time. Let's take a look at Greeley. So Greeley's data with FHFA goes back to 1984, so not as far back as Fort Collins Loveland. But you can see 2021 represented the highest appreciation in that marketplace on record, coming in at about 19%. And then 2022 through 3 quarters comes in at about 12%. The statistical average here of appreciation is 5%. And I think it's important to note, pretty much across the country, you could make a blanket statement that described every single real estate market over the last 2 years. White hot, super high demand, very limited supply, escalating prices, multiple offers. That dynamic is certainly shifting. Real estate has always been very hyper-local, and I think you'll see as we come into 2023 and throughout that year, things are going to vary very differently across the country. So you can't necessarily read a blanket headline that suggests one thing's going to happen here. We'll probably see this in our area where certain areas have a little bit of pressure on prices. We might see some areas actually do better or do more favorably. So it will become very hyper-local in 2023, which is really a return to normalcy for real estate in general and real estate markets across the country. So a big story, obviously, was the number of annual closed sales. So to show you a comparative here, this goes from 2019 through 2020, and it shows the tales of 3 areas: Windsor-Severance, Loveland, and Fort Collins. I'll focus on the last 2 charts, and these are obviously in your annual report as well. Windsor, in the light blue, had 2,168 home sales in 2021. In 2022, saw 1,241 home sales. It was a reduction of 42% number of home sales for the city. Now, there's a couple of things here. One, when you have large-scale new construction development that essentially gets built out, primarily what I'm speaking of is the rain dance community. There's still a lot of construction going on, but the massive amount of numbers that were also equated into there had an impact on the number of closed sales in 2022 coming down. Looking at Loveland, Loveland saw a 28% increase from 2,200 annual closed sales to 1,727 in 22. And then Fort Collins, 3,413 in 2021, and then in 2022, down 27%. This was really the tail of the tape for the majority of the entire region, all following this downward trend. When we look at this also, it's important to note 2020 and 2021, and really the first 2 quarters of 2022, are like nothing we've ever seen in real estate markets. It was, coming off of the COVID shutdowns and really just a white-hot economy across the board for housing, goods and services, travel. Our economy has certainly seen things that we have not seen before. So the number of annual closed sales across the region, so this is excluding Longmont, Boulder, and Estes Park. Again, I said 9,966. That was down 24% kind of across the board, reduction in annual closed sales. And like I said before, we predict that will go down a little bit more in 2023 by roughly about 10%. So let's talk about some of the top stories for 2023. As we end this year, some of these stories have persisted, and I think they're really important to highlight and talk about because they will be the telling sign of what will happen as we emerge through this year. The first thing I want to talk about is inflation and inflation trends. So to illustrate this, I think it's really important. You can get lost in a lot of these economic data points and pieces, but inflation is really where all of this stems of what will happen and what has happened. So this is the monthly 12-month inflation rate for the United States of America going back to January of 2020 and then going all the way through December of 22. So really what happened is in March of 2020, obviously we had the COVID pandemic and we had the shutdowns. We shut down really the national economy and really the global economy. And as a result, we saw inflation, really, really low because people couldn't spend money. They weren't buying a lot of goods and services. They weren't traveling. The Federal Reserve actually lowered the Fed funds rate during that period of time to try to help stimulate the economy. What we got out of that as a byproduct is record low mortgage rates, which we'll also talk about, but that really stemmed a red hot economy coming out. Also, what happened during that period of time is we ended up having major supply chain issues. We had labor issues as a result of shutdowns, as a result of the persistent COVID pandemic. It really became hard to meet the demand for certain products. In housing specifically, new construction building really struggled with supply chain, getting materials, getting skilled labor, and being able to deliver enough housing product for the amount of demand that was there. It's important, in March 21, we finally crossed what is called the Federal Reserve's baseline for inflation. So with monetary policy, the Federal Reserve always tries to maintain a baseline of about 2% increase year over year of the cost of goods and services. Well, we had stepped over that line to about 2.6%, and that was when the Fed had deemed that this was just transitory inflation, where essentially that once things leveled out, once we got people back to work, once supply chain kind of got back into a normalized state, we would see inflation come down. That isn't what happened. And then later on that year, really in October of 21, finally Fed Chairman Powell came out and said, okay, this is not transitory. We do have a persistent inflation problem. That persistent inflation problem was compounded by a few events as well. Russia invaded Ukraine later in that year, or actually in 2022 at the beginning of the year. Why that's a challenge for the U.S. economy is because it sent energy and food and a lot of those other costs up. We had all sorts of oil issues, we've had food and supply chain issues, and that really also put pressure on inflation in the United States, increasing the cost of goods and services. If you also remember during that time, we talked a lot about this at our forecast last year, the labor markets and the churn that was happening. We had more and more Americans switching jobs. We had a lot of people that exited the workforce that did not enter back into the workforce. Well, what happens there is an economic term called wage price spiraling, because so many employers were looking for key workers to meet the demand to be able to supply the goods and services, but they were having to pay more to lure people to essentially fill those jobs. When you pay more, that becomes more consumer spending, puts heavier demand on goods, and you have what is called a wage price spiral in economics terms. You can get runaway inflation in an economy when that happens, and that's a lot of what we've felt across the United States. The next thing here is the Fed finally strategically agreed to raise the Fed funds rate. This really wasn't until inflation was all the way up around 8.5%, which is really the highest we had seen. And they took a very aggressive stance at raising that and did so very swiftly with a lot of movement, raising by 3/4 of a basis point to that base Fed funds rate. Later on that year, President Biden came out and said, we are going to tap into the strategic oil reserves of the country. This was the first time publicly that the United States government had said we were going to tap into the oil reserves to try to lower end consumer costs of goods and services, and really here in energy. They were trying to impact the cost of you, or really the cost to you at the gas pump. because that was really starting to drive really into people's pocketbooks. So that was a 6 months initiative. We finally reached peak inflation in about June of 22. But later on, the Fed has stayed persistent with trying to tamp this down, and they said they're going to continue to take an aggressive stance to do so. So what really got impacted here in the back half of the year was the mortgage market. Now, mortgage rates are not directly correlated with the Fed's funds rate, but it drove mortgage rates up sharply, eclipsing 7% around that November timeline, which really impacted affordability, slowed our markets. We saw under contracts across the country and really in our region down about 35 to 40% as a result. So how we move into 2023, the positive trends that we've seen is inflation is lowering. But we're still well above that Fed baseline of 2%. But these are positive signs, and mortgage markets have honestly reacted more favorably to that. And so to talk a little bit more about mortgage rates, I'm going to welcome up Jason Pfeiffer, president of Group Mortgage, to talk about why there's so much more interest in rates today.
Good evening. More interest in rates. This is the same slide I started out last year. But I stood here looking at bright lights in a completely empty room, right? And I started out looking into the camera and complaining that interest rates had moved all the way up to 3.5%. Today we look, the room's filled, all kinds of energy, and I find myself excited that they've dropped under 7%. So a lot can change in a year, so let's take a look at what could change this year. Looking at all the major players, whether it be the National Association of Realtors, MBA, Freddie Mac, they have interest rates ranging from 5.7% up to 7 1/8. Overall, the average is about 6 1/4, pretty close to where we are right now. But we do need to take these forecasts with a grain of salt. After all, these are the same people last year that said rates were going to be below 4%, right? And so the thing is, as Yogi Berra said, predictions are difficult, especially when they're about the future. And this year that holds true because forecasts, for interest rates has a lot of components that are going to impact it. First and foremost is a lot of what Brandon talked about with the Fed funds rate. The Fed's going to continue to push that higher, and that should move yields across the yield curve a little bit higher. And then the other thing that the Fed has to do is they have their assets that they've done. They purchase mortgage-backed securities and they purchase treasuries to the tune of about $9 trillion. And what we'll see is right now they've been letting that run off slowly as those things mature over the third and fourth quarter, but it isn't going quite as quick as they had hoped. So if they change their stance and actually start delivering those and selling those in the market, along with all the volume of treasuries that we have from funding the national debt, we could see some upward pressure on rates. The flip of that is inflation subsiding. We've seen that looks to turn the corner. As inflation comes down, it's likely interest rates will go down. And a big component of that inflation is your shelter costs. Shelter costs are about 1/3 of the CPI. And the thing is, it ends up being a little bit of a lagging measure, right? And so when we have the high numbers from the rent increases that we saw a year ago, as those start to drop off and be replaced with lower numbers, it should continue to push inflation down and help out interest rates. There's the potential for the economic slowdown, and that could actually be positive for rates. That would give Fed the excuse that they need to pause the increases, maybe have even more of an accommodative policy. And then there's another thing that we look at, which is the 10-year Treasury yield versus the mortgage rates. Typically, what you've seen throughout history is about a 2% spread there, and right now we've seen something closer to 3%. So if that started to normalize, we could see a little bit of a drop in interest rates. What that would do is it'd take a lot of those buyers that kind of went on the sideline in the third and fourth quarter, and they would come back into the marketplace. And so that's something that we'll continue to take a look at. But Brandon will talk about the demographics in just a minute, but what we're hearing kind of on the front lines quite a bit is, I decided to wait until interest rates return to normal. And I guess that makes sense if you're looking at the last decade, right? You look at the screen there and, if they return to normal, it's going to be around 4%. But if you look at interest rates, since 1971, what they're doing is returning to normal. 3% isn't necessarily normal. So I think we need to be really, really careful with that narrative. However, it's really a lot more about affordability and not just rates. So bear with me just for a minute while we run through some math and some numbers. If we take a look at the start of 22, and somebody was out there buying a $500,000 home with 20% down, rate about 3.5%, they'd have a principal and interest payment of about $1,800. Fast forward to late 22, And a $550,000 home with 20% down, we have a higher price of the home because we had that appreciation. Interest rates jumped up about 6.75. They've added over $1,000 to their principal and interest payment. And they also have higher costs for gas, food, services. So the net change for their budget's about $1,300. And I think this story's been said out there quite a bit. But what's missed from that story many times is what's happened to their income during that same time. What you have here is a graph of wages over the year. And you see somebody that changed their job, their income jumps about 15%. If they stayed at their job, it only jumps to about 7%, right? So if we take that example that we just looked at, and let's pretend that household was earning $9,000 at the start of 22, okay? If we go in the middle of those 15 and 7% and assume that they had a 9% increase to their income would have jumped to $9,810, okay? 23 outlook, let's assume the labor market slows down just a little bit, so we just have a 5% increase. Now their income is $10,300. What does that look like for our outlook for homes? Well, if we have flat appreciation, as Brandon just looked at, we still have a $550,000 home. If rates continue to move a little bit lower and a 6% interest rate, your principal and interest payment is $2,638. So you still have a payment that's $842 higher than it was a year ago. And then you still have those inflation costs that we looked at. So your budget still might be almost $1,100 higher, but don't forget, you're earning $1,300 more. So you actually have $217 more discretionary income than you did a year ago. But don't get me wrong, affordability is still a significant challenge out there. So I don't want to downplay that. But looking at this analysis, I think we've turned that corner and have a good outlook for 22 or 23 ahead. Thank you.
Awesome. Thank you, Jason. So the next thing I want to talk about, a top storyline, and this has been one that we've talked about in years past, but I think it really will hold true to what is the demand support to housing? Like, where is the demand for housing? Can we sustain with these prices, and where is that going to come from? And really, I want to talk about the millennial generation. This quote comes from the 2022 National Association of Realtors Profile of Home Buyers and Sellers. It says first-time home buyers decreased to 20% of the market share. It was 34% last year, and are below the historical norm of 40% among primary resident home buyers. This year now marks the lowest share since NAR began collecting data. Now, the millennial generation has really gotten a double whammy. This is a generation that essentially was, exiting college or higher education during the period of time when the Great Recession hit. And so many of them did not get the same advantage that previous generation did. Boomers were staying in jobs longer, the economy wasn't as strong when the millennials came out, and they really had a subdued timeline to start getting to some wage and income earning. So it put them a little bit behind the curve for family formation and other things. They do also have the highest student debt on record for a generation. And so really it subdued them once. Well, they got subdued again in 2022 as a result of increasing mortgage rates. So this is a look at the median age of home buyers going back to 1981 to 2022. And this shows first-time home buyers as well as all buyers. There's some interesting data points here that for all buyers last year, the median age jumped from 45 years old to 53 years old. Primarily, this is being caused because of the increase in prices. Now, those people 53, or where that median age came in, a lot of that was driven by home equity gains over the last expansionary period. There's massive amounts of equity. There's $11.5 trillion of tappable home equity in the United States as a result of, from the Great Recession to where we sit today, of home equity gains. Now, for the median age for first-time home buyers jumped up from 33 to 36 years old. That is statistically the highest on record since the National Association of Realtors has been recording this data. So really what happened was they got pushed again further back. But there is a massive amount of demand support from the millennial generation. You might hear narratives that, they don't want to own homes, but when you see the surveys, roughly 96% say they do want to own homes. They need to save for a down payment. They hope that home prices will come down, but the majority of them do have aspirations for home ownership. This is the U.S. population by age in millions, and the generations are broken out by color. I'm going to identify some key lines here for you. Right here is the median age of first-time homebuyers, 36 years old. What I want you to focus on is this massive amount of population that is really coming of age into where they would purchase homes. There's roughly about 20 to 25 million millennials that is the largest trough of population that is supporting the housing market. So anywhere above that horizontal line is higher than any other generation's population, and this is done by age. So this to me represents substantial demand support for housing over the next 5 to 6 to 7 years. And it's really why a lot of our forecast has prices holding fairly steady. Let's talk about employment. We've always said here at the group and at our forecast that employment is typically a 12 to 18 month leading indicator of what we can expect in real estate markets. Now, that narrative has certainly been challenged as a result of the COVID pandemic because we saw things that we never expected with employment because we've never seen the U.S. economy get completely shut down and the impact that it would have on labor markets. So I want to look at this by county, and this is really a perspective look at the number of employed over the period of time going back to February 2020. So on the left, Larimer County was just shy of 200,000 employed pre-pandemic. It dropped down to 178% or a 10.3% decrease, and then jumped all the way up to 207,000 employed today. That was a 3.7% pre-pandemic, not kind of excluding all of the COVID stuff from where it was then. The state of Colorado averaged basically 3.1% growth. So Larimer County has outperformed the state as it pertains to its employment growth post-pandemic. That's a positive sign, and they've continued to have jobs. We have seen some seasonal trends in a little bit of reduction of employed. A lot of that happens around November and December as employers make shifts to budgets, things like that. Not enough to represent a trend, but we do not see anything for Larimer County that represents any nervousness around employment. Let's take a look at Weld County. Pre-pandemic, 164,000 employed. It dropped all the way down to 146,000 in April during the shutdowns. It's recovered almost back to where it was pre-pandemic, just about 600 some odd jobs short in number of employed. So it's down by about 0.3%, but still healthy return back to where it was. Far from the growth rates that we were seeing pre-pandemic, but really what the focus here is we are increasing employment month over month across the region in these counties. Going down south to Boulder County, 192,000 employed, 167 at the dip during the shutdowns, all the way back up to 197,000 in December. We have seen a little bit of a downshift in Boulder County. Some of that may be centered around some of the larger tech company layoffs, things like that, because there is a higher concentration of people working in that sector. But still, 2.7% growth from pre-pandemic to where it is today, a little bit below where the state average is. And looking at unemployment, unemployment's really interesting because where we were pre-pandemic in February 2020, the state was at 3% unemployment. Today it sits at 2.8% unemployment. Larimer, back in 2020, 2.7%. As of December's reading, down all the way to 2.4% unemployment. Weld, 3%, same as it is in December of this year. And then Boulder at 2.5% in 2020, down to 2.2% as we sit today. So the labor markets and employment markets seem very strong and very stable. So using that as a leading indicator, we don't see anything on the immediate horizon that would represent that. But you can tune into things like our published insider newsletter and focus on some of the trends as we watch this year evolve. We'll continue to update you if we see anything. But on the horizon right now, the outlook is good as it stands for employment. The Boulder benchmark. This is basically our comparison that we've done for many, many years. It takes the same builder built during the same time frame, back in the 1950s, the same homes being constructed in 3 primary areas: Greeley, Fort Collins, and Boulder. And what it does is it gives us a fantastic representation of where prices are in each one of those communities. So if you've been to our forecast before, you've probably seen this. So again, these are modest homes, about 1,000 square feet, under 2,000 square feet, one-car garage, built during that same timeline. Greeley, Colorado's comp from this year sold on June 3rd. It was listed at $349,900. It sold for $361,000. That was $303 a square foot. Going to Fort Collins, our benchmark property here was at 105 Yale Avenue. It was listed at $565,000. It sold on August 10th for $574,300. And that was a representation of $329 a square foot. Let's go to the same essential house down in Boulder and see what it looked like last year. Listed at $880,000, sold at $905,000. This was sold on June 3rd. $786 a square foot. So a really interesting comparison year over year. And actually, we had some audience members a few years ago ask, do we track this and trend this over time? So we've added this. So you can see our Boulder benchmark and where prices have gone. And we've always said, at this forecast statistically, Fort Collins continues to trend and follow where Boulder is. So if you want to know where we're going, obviously you can look at this and see this. And this is going back to about 2010. But really interesting comparison year over year. The last story I want to talk about tonight is development and density. So this is the National Association of Home Builders Housing Market Index. And really, this is the sentiment from home builders of how they're feeling about the market. Now, some interesting statistical points here. Typically, historically in the United States, new construction makes up about 15% of the available supply of housing on an annual basis. I've talked about this supply challenge that we have for a long time, and it's been rampant. There's many projections out there that we're anywhere between 4 and 6 million homes short of the necessary to meet the demand in the United States. The National Association of Home Builders essentially has come out and said, really right now, new construction represents about 30% of the available inventory, which is a lot. So new home construction is incredibly important in development. Let's take a look at how they're feeling about the market. So the top blue line represents single-family sales in the present moment. The dark blue line in the middle represents single-family sales as home builders see it over the next 6 months. And then the yellow line represents their reported traffic of prospective buyers in their products currently today. And this is done all over the United States. Anything under 50 represents a belief that they are in a contracting market. Anything over 50 represents they're in an expanding market. The key data point I want to talk about here is really we met the lows in November and December. What we've seen is we've seen improvement that was honestly unexpected, but as rates have gotten a little bit more favorable and as inflation has seemed to get a little bit more of a grasp from the Federal Reserve's efforts, we started to see in January an uptick. And really the West has been the region that was the most impacted, but the West was the one that responded the most favorably. So we're still not in any by shape or ways an expansion period, but very much continuing on an upward trend, and we'll watch this. The National Association of Home Builders is projecting nationwide a reduction of about 25 to 30% on housing starts for this year, down from 1 million down to about 700,000. So as I said, if they represent 30% of our relative supply of homes, that's a problem, right? Because that's really where we're projecting home sales to continue to lag behind and be a little bit lower for 2023, is because if they're not building as much product and we don't have as much product coming on the market for residential resale, as more and more sellers are rate locked and don't want to move, that's where we see some of those numbers impacted. But let's look at the monthly number of homes for sale by county. What we're looking at right now, that line I just drew across was Weld County. So everybody talks about, are we going to have a massive correction? Is this like 2008? Well, when you look at these inventory levels across time, going back to January of 2013, we're really right on par. So Weld County runs a little bit higher, so a little bit higher inventory currently than some of those years, but not in any necessary statistical off basis. But when you hear statistics like year over year, inventory grew massive amounts, yes, that is accurate, but relative to historical, we're still very, very undersupplied and in good condition. Larimer County, basically below the mark for any of those years going back to 2013 for available homes for sale. So very low inventory. And then new listings. What about all the new listings coming on the market? Don't we have a rush of new listings? Well, we really don't, because all of these, Larimer and Weld County, are at their lowest point in time for new listings coming on the market. So very much continue to be undersupplied. An interesting piece of this is density. What happens as prices run up, and how do we handle this affordability challenge? Well, this is the 2022 percent of home sales by type. So of all the homes sold in each of these areas, how many of them were condos and townhomes, and how many of them were single-family detached? For the region, 79% of homes sold last year were single-family detached. 21% were townhomes and condos. But you look at an area like Boulder there, 44% of their market was townhome and condo, 56% was single-family detached. Density and land use is going to continue to take front and center stage. We're already seeing it take front and center stage in cities like Fort Collins, but all across the country of how do we tackle some of these affordability challenges. I think it's really interesting, though, Colorado has put itself well behind the curve with construction defects. So construction defects law was a law that was put into place in about 2002. I won't go through all the details, but it really prevented the development of condo and townhome projects for sale. It wasn't until late in about 2017, 2018 that law was repealed, and now we've started to see influence and builders and developers enter into that market. But we've been well behind the curve because we didn't have that product delivered during that more than a decade period. So to talk a little bit more about density, development, and what the future holds, I would like to welcome up some of our panelists this evening, and we will need some microphones. But I would like to first welcome up Mr. Scott Ballstedt. He's the Director of Planning for the Town of Windsor. He manages all of the land use planning, development review, and building programs for the town. He's got 30 years of planning experience, and we're grateful to have you here representing Windsor. Take a seat there, and then we'll get you a mic. And then I'd also like to welcome up Mr. Bob Paulson. Bob is the planning manager for the city of Loveland. He has over 30 years of experience as an urban planner in both the public and private sector. He's here to represent the city of Loveland. And Mr. Don Toronto, the Public Works Department Director for the town of Timnath. He's a licensed professional engineer and president of TST Inc. Consulting. He's been contracted and worked for Timnath over the last 10 years. I was sorry to say that our representative from the city of Fort Collins notified us late today that they would not be able to make it due to illness, but I did get some responses from them as it pertains to some of these questions. But let's talk a little bit about development, and I'll go in order, Scott, and talk a little bit more about what are the current priorities of focus area of impact for your area, your city, or your town right now as it pertains to development.
Sure, thank you. And actually it ties into what you were just talking about with density just a minute ago. Our comp plan, when it was last updated in 2016, really stressed the need for Windsor to diversify our housing stock. Oh, I'm sorry. Sorry about that. Our comprehensive plan really stresses that we should be diversifying our housing stock and actually looking at more density and multifamily projects, like you mentioned, not only for the affordability and the just being able to serve different members of our community, but also from a water standpoint, it obviously reduces our water obligation. So our comprehensive plan really is stressing the higher density, and we're currently going through a comprehensive plan update, and we'll be probably diving even deeper into that as well. So that's probably the biggest thing that our comprehensive plan is stressing.
That's awesome. I'd like to go to Bob. I'd like to ask you the same question. What are the current priorities and focus areas of impact for the city of Loveland and the future of the city of Loveland?
Well, Brandon, I sound like a broken record here, much like Windsor and many of the things that you were talking about. Certainly, density is a factor. We wrote a new zoning ordinance 4 years ago, and we made sure that there was allowance for new product types in that ordinance, including going down as small as micro homes. But what we're seeing among the home builders and those that are actually building and the developers is the continued desire for smaller lots, not necessarily smaller homes, but smaller lots, increased product type, attached units, that type of thing. So density, small lot, certainly the city is very concerned about attainable housing, working very hard on affordable housing. Some of the areas that we are very interested in Loveland is downtown. You may have been reading about that recently with the Draper project and parking structure. We're also seeing home building in all areas of the community. One of the things that I was talking to Scott right before we started here today, and he indicated that there's not a lot of building activity or new permits being issued in Windsor. We still have permits that are being applied for on a weekly basis. You know, we have slowed from the sort of the top of what we were experiencing a year ago or more, but a pretty steady permit subscription. We're seeing home building. I think Loveland has been behind the curve a little bit in the region in terms of home building, at least for its size. And I think now that developers and builders, both regional and national, are discovering Loveland, and there's a lot of land availability.
I'm just curious before we move on to Don, of the majority of the proposals that you're seeing and coming to review, based off of, is there any percentage or an allocation of how much attached product versus single family detached? Do you have any reference there?
I can tell you, I don't have those percentages off the top of my head, but there is a lot more interest in the attached product than we were experiencing in years past. And I think that we will keep seeing that grow in percentage. And it's just a fact that the cost of construction, the cost of land, the cost of water, all those factors are driving prices up. And many developers are trying to hit that sweet spot in home builders, and that price keeps rising.
Yep. Well, thank you. Would you mind passing the mic over to Don? Don, you guys have a lot of things going on. There's been a lot of dirt movement in Timnath, a lot of projects of interest. I'm curious, what really are the focus areas of impact for the town of Timnath?
You're right. There's been a lot of activity in Timnath, and some of the major areas that we're focusing on is trying to stay ahead of the development with major capital improvement projects and things to support development. Our Harmony Corridor, if anybody's driven that, and they probably have, there are times of the day that's a little less friendly. We're doing everything we can to try to stay ahead of that. And so the CIP component of this is very important, and we're seeing the same things that Scott and Bob talked about as far as multifamily development. And Timnath is small. We're the small sister to all of these other groups, but we're seeing some of the same needs as far as smaller lots and multifamily development. So that's on the radar, and it's happening.
Perfect. I'll leave. You want to say something?
Well, I was just going to say, when you were asking about the percentage of multifamily versus single family, Windsor had a really unique 2022 in that obviously the single family homes fell off after the interest rates went up, like you described. But we had enough multifamily projects in the works and in the pipeline that we actually, for the first time, we permitted more dwelling units in multifamily than we did single family this year. So which is very, I guess, record breaking for Windsor, because for years we've always been a bedroom community, and single family detached homes is what we built. But over the last 4 or 5 years, we have seen a much bigger percentage of multifamily.
I'll ask you the next question. You've touched on a lot of that, in that last statement, but how has residential development changed in other ways, and what do you think the current challenges are, and what do you think the potential opportunities are? Is there anything, in addition to what you've already said that you want to highlight?
I guess the changes, you've really touched on a lot of them. We did also update our land use code in 2020, and we modeled a lot of the new land use code off of the Rain Dance project, which got into some varied lot sizes, smaller lot sizes, mixed use ideas. And so that project went through a PUD process. We tried to amend the land use code to make it simpler to go through that and implement some of those ideas in future projects. And we're starting to see some developers take advantage of those.
Yeah, Bob, how about you for Loveland? What really has changed? Is there anything massive that you've seen change other than what you talked about with attached and detached product?
Well, again, as I mentioned, smaller lots, more product type. Many of the developments that we're looking at, new subdivision designs and those in the entitlement process, are looking at multiple product types ranging from multifamily down to duplex type units, townhomes, and then single family on smaller lots, and then sometimes with a little bit larger lot. And we're also seeing a lot more interest in having kind of that open space amenities, not necessarily manicured amenities, but trails and open space areas that are just left pretty natural. We also, and I have to speak to Don's concern about the roadway situation. The city of Loveland, especially those of you who have driven on Highway 34 Eisenhower in Loveland recently at rush hour, you'll notice that there's a great deal of work going on there, and we're trying to keep up with that situation, not simply on Highway 34, but across the city, and it does require a great deal of capital expenditure to keep up. But in general, we're just seeing the interest in developers and builders trying to reach the market by making homes a little bit smaller, often attached, and smaller lots.
Yeah. Well, thank you for those points. Don, I'd like to know, from your perspective with the town of Timnath, what really has changed? What are the opportunities and what are the challenges that you guys currently face?
Well, it's similar to what Scott and Bob talked about. I mean, we're seeing the demand for multifamily, lower price points, and those sort of things. I think our challenge a lot of the times is educating the public as it relates to how multifamily and or more density relates to their single family, because we're obviously more single family than multifamily. And so the general thought process that we hear back is that multifamily will drive down their home values of the single family. That's just not true, but that's what people believe, and we're trying to counter that with education and understanding. But every time multifamily projects come in, we have a lot of dialogue about that. And so I think that's one of the challenges in the future, just to educate everybody.
I found it very interesting that, Timnath, and obviously the number of sales as a percentage are smaller than the bigger cities, but you guys came in trailing behind Boulder only, even ahead of Fort Collins in terms of attached to detached product. And I thought that was a very interesting statistical point. And I don't know if that caught you by surprise.
It definitely did. I did not know that. But it's encouraging, because that's exactly what our comp plan wanted to do. We want the diversification because we understand that strengthens the community, and we want to just educate everybody to that. It isn't common knowledge, and so the educational component of this, I can't stress it enough. And it's if you have some magic pills or ways to get that education out there, we'd like to buy some from you.
There you go. I'm actually going to go back to Bob in the middle. I think it's always interesting, and the people here would love to know, what projects and note are really defining or changing the future, the specific projects. I just saw some news today that there was, potential for a Whole Foods going in Loveland. I won't put you on the spot there, but I'm just curious from your perspective of what are the projects of note that are really shaping the future?
Well, that project that you're mentioning that includes Whole Foods, it's proposed. It's just in the proposal stage, but that's very exciting. It's a McWhinney project that will be part of Santerre if it goes through. I can't remember the acreage. I think it's about 150 acres. It includes a 40,000 square foot grocery store and quite a bit of other commercial, and then multifamily and a smaller mix of single-family detached and attached units. But that is going to be on the south side of Highway 34, right across from the Gateway, the Target area. So that's a big project for the city. We're excited about that opportunity. Another project that I'm sure most people in this audience know about is Kinston, another McWhinney project, and they're not the only developer in Loveland by any means, but they have really worked to create kind of a town center in their Kinston project. And one of the things I was going to mention is what are the opportunities with these smaller lots and increased densities and perhaps the amenity packages that go with that. It creates the opportunity for more walkable communities. You know, people would say friction in a positive way. You get to, be able to walk to, whether it's walking on a trail system or walking for a cup of coffee or something like that. But I think we're seeing an interest in the community in those kinds of amenities and walkability that perhaps wasn't so important 10 years ago, 15 years ago, but it's certainly in growing in importance.
Yeah, thank you for sharing. And honestly, in this, it doesn't have to just be centered, around residential. I also am interested in commercial from all of you. But Scott, what projects of note for Windsor are really on the horizon or really making a major impact in the future?
Well, I think you mentioned rain dance earlier, and that's really been the driver of a lot of our residential building permits over the last 5 years. We actually thought that project would build out a little more slowly, like Water Valley built out over 10 years, and Water Valley South built out over 10 years, and Rain Dance built out in less than half of that. And so I think we'll see a little bit of a lull right now while Rain Dance is building out and the Ridge at Harmony Road is building out. But we do have a lot of, I think our next growth area will be north of Main Street, north of, between Highway 257 and Weld County Road 15, and south of Weld County Road 72. It's just northwest of Windsor Lake. The Prairie Song development is a Hartford community that they've got a master plan for, I believe, almost 3,000 units, or not 3,000, 3,000 units when combined with the two projects to the south of them. There's an Overland annexation and Trevenna annexation, and they're all in that same area just north of New Windsor, if you're familiar with that neighborhood. And a combined 3,000 units in that area is really probably we're going to see our most growth over the next 10 to 15 years.
Yeah, that's exciting.
Yeah, from a commercial standpoint, our economic development team is working on a lot of different projects. The big one that's always in the news and is kind of in fits and starts moving forward is the Future Legends Sports Complex. We meet weekly with their team, and they are moving forward on various aspects of the project. And I know there was an article yesterday that talked about playing baseball and soccer in May, and that's an ambitious goal. We're really working hard with them to try and make that a reality, but they do have their sports dome up, and they're actively hosting soccer tryouts and volleyball, and so it's exciting to see them be able to take advantage of a small portion of the site, and then the rest of the site's still very much an active construction project. So.
Yeah. Well, Dawn, maybe a little smaller in size, but you guys don't have any shortage of projects going on. I'm a Timnath resident, and so I see a lot of them. But what projects are really shaping the area for Timnath for the future?
Well, on the residential side, we've got long-time projects like Timnath Ranch, and Harmony, and the project that's just about to, that is breaking ground, is the lakes that is just north of Harmony, and that's going to be bringing a lot more residential components to the table here real soon. But all the existing developments are doing very well. The commercial component of it is the exciting part of a lot of different things, because we've got the Harmony corridor, which is now just starting to develop, and we're excited about that. The commercial corridor along I-25 and the Harmony intersection, obviously has some nice retail there right now, but there's a lot more potential, and so that's front and center for us at the moment, looking at the future for those, and they do create some traffic, and we're ahead of that, we hope, also.
Awesome. I'm gonna stay with you real quick, Don. I think water is something we talked about last year in our forecast, and I think it kind of gets put to the back of people's mind, but water is a very precious resource, and its cost and its access to the water is continued to be a challenge for Northern Colorado. I'm curious, what's the current role of water in Timnath, and how that becomes a challenge or an opportunity for you as you guys look forward into the future?
Yeah, for sure. Well, Timnath is in a little bit different situation than either Windsor or Loveland, in that we don't have that utility. I mean, we look to existing districts like the Fort Collins Loveland Water District and the Elko Water District and North Weld to provide that. So we partner with those folks very well. We talk to them all the time about the growth and about how to make that work for both them and us. But at the same time, we're very aggressive in going after non-pot systems. And so the town is pushing that with all the town's components, and we try to influence developers to add non-pot systems whenever they can. So we think that has a significant influence on the amount of potable water that's needed. So we're going to continue to do that, and we're going to continue to champion that from the town's perspective.
We'll come back to Bob and ask you the same question of, really the current role of water in Loveland, and how that's a challenge or an opportunity, and what things maybe you guys might be doing creatively behind the scenes to try to address it.
Certainly. Well, I think in Northern Colorado, water is going to be an increasing challenge, and it's perhaps going to be increasingly expensive. The City of Loveland has done a great job in terms of planning for securing water resources for the future. But I think there's recognition recently. We have a task force that was just initiated by one of our council members to particularly look at the water coming from the west slope. And I think we get about 40% of our city water resources from the west slope water. So there is a concern as the climate gets drier and hotter, as predicted, that that source of water may diminish. And so the city is looking in kind of an overall picture and long-term way to figure out exactly how we can secure more water. We do have a reservoir project, Chimney Hollow, that is in the works, that is shared with a number of other communities and entities. So I think we're in good shape for the future, but I think there's a growing awareness that we have to be very careful. And from a planning perspective, generally the city has not been, we've been pretty good and lenient in terms of our water use. We do have and water restrictions, but there's a growing interest in having more water-wise land use, and I think that we'll be pursuing amendments to our code in the second half of the year in just trying to facilitate a better, more water-wise orientation. Mm-hmm. So it is a big deal, but I think we've planned well, and we will continue to take additional steps.
When all said and done, how long will it take to complete? Obviously, Chimney Hollow has been a long project. You guys, any estimates? I mean, I know that you're not.
You're asking the wrong person.
That's what
the work is, the front end of trying to get approvals for the reservoirs is very lengthy, and I think this might be the only reservoir, it's certainly on the Front Range, that is being constructed at the present time. But I think it's just a few years away from being functional. I know that there's work ongoing, and it started last year So we're looking forward to that, but I can't give you the time frame.
Gotcha. Scott, how about for you in terms of the current role of water with the town of Windsor and how you guys see it as an opportunity or a challenge and what you guys are doing to address some of those concerns?
Well, like Timnath, we have three different, we have water, we get our water from Loveland, Fort Collins Water District on the west side of town. The northern part of Windsor is served by the North Weld County Water District. And then the core area of town we serve ourselves. But we get our water from Greeley, from North Weld, and from the districts on the west. This is where I would normally turn to our water resources manager and turn it over to him. I know that with NISP on the horizon and having those obligations that we see coming at us, we'll probably be looking at, I think the town board will be evaluating our water policy monthly just to make sure that we're making the right decisions in terms of what we're requiring when development comes to town. We either require cash in lieu of water, or we require that they dedicate raw water shares. And so I think it's really going to be not, pardon the pun, but a really fluid situation where the town board is looking at our policy very closely and just making sure that we're being as wise as we can. And similar to what Loveland's doing, we're looking at our code. When we did the code update a couple of years ago, we did add some water-wise elements, and they are none of them are mandatory, but I think we're probably going to be looking at some higher standards for watering. We also, as Timnath, we promote non-potable irrigation systems whenever the land was previously irrigated crop. And so almost all of the subdivisions that we've been working on over the last 25 years have non-potable irrigation systems. And so that does reduce the amount of treated water that is used on landscape. So.
Fantastic. We're almost out of time, but I wanted to give each of you an opportunity to share some final thoughts of what do you think is important to communicate to end consumers or end residents of your town, and potentially to the developers, or any final thoughts that you want to share from your perspective as you guys look at the future of your cities, and what you'd like people to know or what you'd like the developers to know from your perspective. You can take it in whatever order, whoever's ready.
Oh, no. I want to hear this first.
Yeah.
I'm looking at my notes.
Yeah, just any final thoughts from your perspective, from the perspective of Loveland. And I'm also curious about how much collaboration goes on amongst you guys, and the collaboration of the different towns, cities, municipalities. I'm curious from that side of the planning and development.
We're kind of sneaky about that. We look at what other cities are doing in terms of their initiatives, but we do have some coordination. But I think, I don't know how it works for the two of you, but we're pretty. The issues that we're trying to tackle successfully are consuming enough that we're not spending a great deal of time. We do coordinate with other communities, but we're really looking to see what changes they're making and what ideas that they have all along, up and down the Front Range from Denver and suburbs north. So we're aware of, Scott, what you've been doing, but we're also very focused on our own issues. So. And I'll talk about some of the things that, as long as I have the mic, and Don is reluctant over there, which I find to be very unusual. But in any case, we are concerned also about the high interest rates and state of the economy. And I think the city of Loveland is, I know the city of Loveland is very concerned about attainable housing, making sure, like you mentioned, the millennials, housing is available for folks that are coming into our workforce or have been in our workforce. I think the city council and city staff are very concerned about that. And that's one reason why we're looking to develop more allowances for small lot and attached product development and multifamily. Also, we're very concerned about the homeless situation. You may have read in the press across the board in northern Colorado, communities are working to deal with that, and as we are in Loveland, looking to provide some form of assistance to affordable housing developments or developments that have affordable housing components within them. So that's been very important to us. One thing I wanted to mention, and this is something that we have seen recently, and this is a little bit out of sequence here, but we have seen a number of subdivisions coming in or being proposed, or people talking to us about rental subdivisions, and that seems to be a trend that is growing across the board. So we're expecting to see more of that. None of us have mentioned that yet this evening, but that seems to be something that is happening in response to the economy.
You're referencing the build for rent communities?
Subdivisions that are built for rent, whether single-family detached or more commonly in a duplex type setting, so that you get your own unit, so to speak, and perhaps a piece of yard, but you are eventually you're a renter that is living there, but full neighborhoods to that effect. So I think that's something that we'll be seeing up in northern Colorado more of in the coming years. But anyway, those were some of the things I wanted to mention. I also wanted to mention, and I'm not trying to hog the mic, but one of the areas that we're really focusing on, and I hope Water Valley and Martin Lind are successful in this, along with the ranch, Larimer County, in expanding the county's facility here and having associated development that's very important to tourism in not just Loveland, but the vicinity for all of us. And certainly Windsor has done a really excellent job as we move a little bit to the east in that area. And so that's something that we're really looking forward to, is to furthering the facilities here at the ranch, and as well as facilities like this that are private. And I'll stop.
Did he give you some primer?
Okay, yeah.
Okay.
That helped a lot, Bob. I appreciate it. So I think one of the things that people can expect from Timnath in the future is that we're going to be just like the other communities in terms of having more diversification of product. All the developers that are in Timnath want more diversification. I think the public wants more diversification. You're going to see that. I think the other thing you're going to see is that I think Timnath's small, we're very nimble, and I think we're very creative. And so you're going to see a lot of different things happening there, and I think the velocity of it, I think, is going to be significant also. Even though it's much smaller, the numbers are smaller than the surrounding communities, I think we're going to be very competitive to get all those things. And on another note, just for cooperative natures, Timnath Public Works, we have an IGA with Loveland, and so they do all the maintenance on all our vehicles and plows and things like that, which really has helped the town, and I think it helps Loveland a little bit, and I think it creates a spirit of cooperation, which is helpful, and I think there should be more of that, actually. But I think the future is bright for northern Colorado, and Timnath hopes to be right in the middle of that.
Fantastic. Thank you for sharing. Scott, you want to wrap us up here?
Yeah, I just would piggyback on what they were saying. We've got intergovernmental agreements with both Loveland and Timnath as well, and we've collaborated quite a bit in the Brands area out here, and with regard to Fairgrounds Avenue, trying to make sure that it won't look like two different communities, one on each side of that it'll be planned seamlessly. And then I also wanted to point out another area of collaboration that Loveland's Housing Authority has been just great for Windsor, because we had a small town housing authority several years ago, and we partnered with Loveland's Housing Authority and have worked very closely with them, and they've helped us to apply for grant funding for senior housing projects. We do have a couple of projects that we're hoping to get built in Windsor in the near future, but I just would be remiss if I didn't say that Loveland's been great to work with from the Housing Authority standpoint as well. But like Don said, I think we really do have a bright future. We've got a lot of cool projects in the works, and can't wait to see them come to fruition.
Fantastic. Well, thank you all of you gentlemen. I really appreciate your insights. Can we give these guys a round of applause? You guys can take your seats. Yeah, you can just leave it there. Perfect. Well, with that, I want to wrap up our 2023 annual forecast. A little bit of outlook for you. So obviously, we see still a very bright future for Northern Colorado. If I was giving advice to buyers in this marketplace, my advice would be this. There are some great opportunities that are out there, both on the new construction side and residential resale side. There's opportunity in concessions, in buying down rates. And this idea of trying to time a market, I think people need to be really cautious. You really can't time a market. And so if I was a buyer sitting out there today, I'd be paying attention to what continues to happen, but don't miss some opportunities that may exist in a short window. For sellers today, I think it's incredibly important to be very realistic and strategic with your pricing. To understand that while yes, it is a seller's market, you aren't in the driver's seat like you were before. For investors, my recommendation to investors would be understand that rents are still great and there still is a lot of competition, but don't be so aggressive. Rental rates are starting to see a trendward down and really helping to ease a lot of some of those inflationary pressures in our economy. So I want to say thank you to each and every one of you who attended tonight. I hope that you found this informative. I want to thank our builder representatives. I'd also like to thank Group Mortgage, the Source Property Management, and Guaranteed Title Group. We've got lots of food and drink. I want to thank our marketing team for helping put on this amazing event and all of our partners. And thank you for taking time out of your day to hopefully learn something and come out here and be with us tonight. But we'll wrap up our 2023 forecast. I hope you all drive safe and have a wonderful evening. Thank you for attending.